Cathie Wood has revealed the truth about the Tesla stock sell-off. Did you know that? Since Cathie Wood is a well-known supporter of Tesla, pay close attention to what she has to say about the sell-off. Regarding stock prices in the stock market as a whole, the majority of investors and investment enthusiasts heavily rely on analysts' opinions. This is due to the fact that the aforementioned experts, before offering commentary on various equities, always consult data that they have carefully examined. Well-known investor Cathie Wood is someone whose opinions are respected by those in similar fields. Watch the video now to hear Cathie Wood's thoughts on the Tesla sell-off. Tesla is an American automobile, a sustainable energy firm that creates, develops, produces, leases, and markets energy generation and storage systems, as well as electric vehicles in the US and other countries. With aspirational and environmentally conscious objectives, Tesla rose to global recognition. What does a sell-off entail? A sell-off is, by definition, the sale of assets, usually at a low price, done with the purpose of getting rid of them, as opposed to a regular trade or just the selling of stocks, bonds, or commodities, especially if the selling results in a price decline. A sell-off happens when a lot of securities are sold quickly, which drives down the price of the security since more shares are offered than buyers are ready to take. When market sentiment becomes more negative, the price reduction can quicken. According to some accounts, Cathie Wood is an American investor, renowned stock picker, and the founder, CEO, and CEO of ARK Invest, a $60 corporation that makes investments in cutting-edge technologies, including genomics and self-driving cars. Because she not only has the evidence to support her remarkably astute statements about investments, but she is also extremely compelling in her arguments. Cathie Wood is frequently referred to as the most underestimated investor in the game. She is well known for giving monthly updates on a variety of topics, including innovations, monetary and economic policies, what's to be expected in her area of expertise, and her thoughts on Fed decisions. They are attempting to ascertain why Elon Musk recently expressed that he felt extremely pessimistic about the state of the economy, according to Wood. In reality, after supply chain problems caused the company to have a particularly difficult quarter, Musk wrote in a leaked email to his staff that he had a really negative feeling about the state of the economy and urged them to work harder. According to Cathie Wood, they are attempting to ascertain what he is looking at in order for him to make such a statement. As she stated that they had concrete proof that in May, sales for Musk increased globally by 60%, while sales for nearly all other automakers decreased significantly. Nevertheless, given that Musk's sales appear to be strong aside from the margin, Wood surmises that Musk was not motivated to make that statement by his sales. It's possible that he is thinking back on the drop in car sales. JP Morgan Chase CEO Jamie Dimon discussed hurricanes and gave advice on how to be ready for them. He is uncertain about the nature of the hurricane and whether it will be severe or not. Furthermore, others claim that since his employer, JP Morgan, released its profit results a month ago, he has altered his tune. Dimon claims that he observes a lot of business activity and that he must be witnessing a slowdown. In his career, Goldman Sachs president John Waldron has defined such an atmosphere as an extraordinary convergence of shocks. Since Waldron has an excellent global perspective across all industries, Wood surmises that these three business titans are marginally under stress regarding the state of the economy. When it comes to emerging technologies with exponential growth potential, renowned technology investor Wood sees a big upside for this electric car behemoth. Electric automobiles have sparked almost as much enthusiasm as anything else. And not only are they a crucial component of a future powered by clean energy, but Tesla is demonstrating that it can make these cars at a larger profit margin than automakers that use combustion engines. One of Wall Street's biggest Tesla believers is Cathie Wood, the CEO of ARK Investment Management, which oversees a number of exchange-traded funds and ETFs that are innovation-focused. Within the ARK, autonomous technology and robotics ETF Tesla stock has the top position, followed by ARK Innovation ETF, ARK Next Generation Internet ETF, and ARK Autonomous Technology and Robotics at EWF. The funds possess more than 1.3 million shares of Tesla together, which are currently valued at $911. Since Wood cashed in some of his earlier gains due to the larger tech sell-off, the holding has decreased from its peak of approximately 5.6 million shares, but ARK is about to acquire millions more shares, a result of Tesla's impending stock split. Remember to click the like and subscribe buttons to receive updates on new information about Tesla stock returning to the video. Tesla is the world's largest seller of electric cars, having shipped over 1 million units in the previous year. The CEO of Volkswagen Group, a major rival, has praised the company for its extraordinarily efficient manufacturing processes, which outperform those of the competition, rivaling other automakers in terms of gross profit margin. Tesla has built an impressive vehicle. For instance, in the first quarter of 2022, its margin more than doubled that of Ford Motor Company, competitor American automaker. Said numbers will undoubtedly rise as Tesla keeps increasing production at its 2 gigafactories in Germany and Texas. Higher gross profit margins translate into higher earnings per share at the bottom line, all other things being equal. Divided by the total number of outstanding shares, earnings reflect the company's net income. At Tesla, the statistic increased by 633% in Q1 2022 compared to the same period the previous year. In spite of the recent sell-off in tech, which has caused Tesla stock to drop over 40 sen from its peak, Wood remains quite optimistic about the long run. It's no secret that supply chain problems and more difficult economic times are some of the short-term hurdles Tesla faces, which may reduce demand for pricey purchases like vehicles. However, ARK revised its Tesla modeling in April and disclosed a price estimate of $4,000 per share by 2026, or $1,533.33 per share following the split. This is a 560% increase over the current price of Tesla stock. In ARK's extreme bull case scenario, the post-split price of Tesla stock may increase by 732% to $5,800.19. This is presuming that the business sells 17 million vehicles by 2026 and that a sizable portion of Tesla's revenue will come from its upcoming autonomous taxis. Production of these is expected to start in 2024. And even so, ARK's pessimistic scenario, which calls for a price increase of 316% from the current level at $2,900 per share, or $966.66 after a split. Even if some of those numbers seem unfathomable to the average person, it's important to remember that since going public in 2010, Tesla has returned more than 18,000% of its initial investment. Put simply, a $10,000 investment in those days would be worth more than $1. 8 cents million. Goldman Sachs analyst Mark Delaney underlined the significance of Tesla's pioneering role in the development and production of electric automobiles. He continued by saying that the corporation might benefit from the trends in the deployment of electric vehicles around the world is sales. These optimistic projections stem from the possibility that adoption rates will differ from what he predicted. Furthermore, he stated that a slowdown might narrow Tesla's and its rivals' advantages. 5. It is no secret that several automakers, including well-known reputable ones, are rushing to match Tesla's infrastructure and technological advancements. As a result, Tesla needs to act quickly to stay ahead of the competition and keep a safe distance from businesses entering the EV market. Nevertheless, a lot of people, investors and analysts alike, are optimistic that Tesla will continue to lead the field. Given the high level of faith held by so many, Tesla ought to make every effort to hold on to that position. It is evident that Tesla is working very hard to keep up its position as the leader in EV manufacturing. In order to keep its factories and plants operating during the pandemic, Tesla rewrote its software and switched suppliers while other manufacturers and companies struggled with chip shortages and supply chain delays. In actuality, Berlin and Austin now have 2 additional Tesla manufacturing sites available. The goal of these additional plants is to boost output in tandem with the Fremont and Shanghai units. These advances may result in higher operating margins and greater manufacturing scale. They can now attain larger gross margins thanks to the establishment of Austin and Berlin. Even analyst Dave Levy of Credit Suisse reaffirmed his optimistic assessment of Tesla stock. The share's recent decline, according to him, is a compelling entry point. It will be hard to forecast the global economy's future performance with any degree of accuracy, so you should wait to make a significant investment to see how the stock market is doing. If you like this video, check out our other videos by visiting our channel